Okay, guys, I'm just getting the recording going. Good morning, everybody. Good to have you on screen. Going to go ahead and start into our meeting. We have a lot of ground we're going to cover today, including some novel ideas on in financing, and from financing to the listing agreement. We're covering a lot of ground today. So what will be covered today is we have Ted Leoracos coming up in just a moment from United American Mortgage. And we've asked him to cover the math on buy downs, whether it's a life of the loan buy down or a temporary buy down. And if you're not sure what a buy down is and what the difference between those two is, that's what Ted's here to do today. And why your seller should consider offering buy down to buyers. It's something that's been completely off of us veterans' radars for years, but now it's very much in the forefront of what we need to do to sell property. We're going to cover 3 free tools to help your client with their next move. You're about to gain access to, as part of that moving, software called Updater through SkySoap. I'm going to tell you a little bit about that. In the new RPA, we're going to cover how the entity buyers and entity sellers boxes work. A lot of people aren't using those, and it saves you some steps, so we'll cover that today. We're going to do a flyover of the newer parts of the listing contract, and that's just based on the stuff I get the most questions on. I'm going to go through 3 classic client retention strategies. Nothing new there, but just stuff that you have to know about. Hyperlocal market sales stats just for the past 7 days. Is anything selling? We're going to talk about that. Then we'll go into plugs and wants. And with that, we're going to turn that over to our best friend in lending, Ted Leoracos. Give Ted a round of applause virtually. Hey, Ted.
Thank you. Thank you very much. I appreciate it. Once again, it's an honor and a privilege to be here at Aramis Real Estate. And I just can't tell you how interesting our topic is today, because the last time this topic came up, my hair was black. That's how long ago it's been. And, it's ironic how the market has shifted so quickly. As recently as 3 weeks ago, we were being asked about the bridge loans, the pay cash and then refinance later. Charlene Bird sitting right over here. We have a client we've been working with trying to get a bridge loan set up so they could buy without selling the property. Well, all of that has dramatically shifted. And now all of a sudden, I'm not seeing purchase contracts where we're waiving appraisal contingencies. I don't see that. I'm seeing that in like 2 weeks. Right. I am not seeing shortened contingency periods for inspections. I was seeing them with no contingency with inspections. The market has shifted. So within the last 10 days, I have had so many people asking about buy down loans. I thought it was important to go over what there are. There's 3 different buy down loans. We're only covering 2 today. You can reach me later if you want to talk about the third one, because I don't think the third one's ever going to be relative again. But let's talk about the 2 most important ones. On your screen, you're going to see the permanent buy down. Okay, permanent buy down means that the 30-year fixed rate that is now obviously higher than it was a few weeks ago is a stall for buyers. They saw 3.5% a short time ago. Now, all of a sudden, they don't see 3.5%. The average rate is around 5.5%. So I've put in the first box here the math as it would stand yesterday. And yesterday, assuming a 5.5% 30-year fixed rate, see where it says at the top left, no point. If you scroll all the way down.
If you use this mouse, they can see that arrow.
Oh, beautiful. Okay, so see where it says no point loan right there. Scroll all the way down. You can see the 5.5 is the rate. You can see the interest, the principal, the taxes, the insurance. Of course, it's all estimated. And then the net payment of $7,350.
Wow, oh, that's a payment.
It's $1.3 million house, 20% down, $1,040,000 loan amount. So now go to the right, and you see where it says buy down. So now what has happened is the seller in this case, doesn't have to be the seller, but I think you're going to see this more and more. The seller, rather than reducing the price of a property, perhaps will agree to pay money to buy the buyer's rate down to 4.375. See where that is? 4.375. Scroll all the way down, and you see the payment is now $6,638 a month, a savings of $712. I'll get to the bottom, the next slide in a moment, where we share what is the seller paying. Right now, I want to focus on what is the buyer. Yeah, that I want to focus on what is the buyer getting if this happens. So now let's go to the third one, bigger buy down. Okay, bigger buy down means the seller pays more money. The interest rate now is 4.25%. So now you can scroll all the way down. You can see the payment is $6,561, which is a $789 difference. So if you look at this payment right here versus this payment right here, what you're going to notice is it's just under $9,500 a year difference in monthly payment for the life of the loan. And I hate to sound or quote a used car salesman, but a famous used car salesman once said, people don't buy the loan, they buy the payment. Well, this is an example. If you have a client that needs the lower payment in order to get to the finish line, this is what a permanent buy down is all about. So now we're going to go to the next slide. So the next slide is basically the closing cost impact. And you're going to see I took out escrow, title, loan doc. I took out all the stuff that just makes the math confusing. Obviously, they're going to have that, but I only left in the points. If you look at the example one, remember the example one, the point in example one at 5.5% was 0 points. This is a 0 point loan. 5.5%.
If you go back, you can push page up.
Oh yeah,
See
yeah.
page up, you can go back, and then page down goes back down.
So I want you to note this is the column one, column two, column three. Okay, now when you go down, there's column one, column two, column three, just so we keep the math straight. So this is column one, 5.5% interest rate. They're putting $260,000 down. Relative to points, they pay nothing to get the 5.5. So now move over to this one, $15,600. So here's a conversation that could potentially happen. You're the real estate professionals. I do these YouTube mortgage talk with Ted things. And what I have learned since 1980 is that I don't know anything about real estate, but here's what I do. I know math, and here's the math. If you have to sit down with a client and say, all right, your house is on the market. We need, say, a $15,000 to $20,000 payment reduction to get somebody to come in and buy the property. That's a very slight difference in payment at 5.5% interest. That's not really going to motivate a lot of buyers to move forward. But here's what will motivate them to move forward. Don't drop the price. Offer a $15,000 seller paid concession to the buyer to buy down the interest rate. Let's go back up.
Now, to your knowledge, Ted, would that be deductible for the seller? Would that be
Yes, absolutely. Absolutely. Yeah.
Tax deductible.
Yeah. And if you find the appropriate accountant, maybe the buyer can rent, because buyer's paying points.
Huh?
The seller is issuing the credit. But I'm not going to go down that road officially because I'm not a CPA. But I have in the past seen it. And remember, my hair was black last time we did buy down loans. So it's been a while. But this is a powerful tool, and it's old. It's old as dirt, but it's effective. Let's go back. Let's look at the third buy down. Here's the third buy down. Picture yourself at the kitchen table. Mr. Seller, instead of dropping the price $26,000, which really doesn't have much of an effect to the buyer, because remember, it's about $5.25 per thousand. So if you take 26,000 and reduce it by $5.25 per month, is that going to motivate the buyer to say, okay, now I'll buy this house? I would submit to you that possibly not, but I can show you the math where $26,000 not reducing the price, or possibly a combination of two things, But $26,000 towards the cost of the buyer's loan, there's the net. Just dropped his payment by $789 per month, which is how I get the $9,468 per year savings. That, I think, will motivate a buyer to say, okay, because basically what has happened is the seller, instead of dropping the price, has turned back the clock to what rates were when the buyer probably got pre-approved. I can paper my wall with pre-approval letters where the interest rates are in the high 2s, mid 3s. And I can tell you, those people, they're not racing to make offers right now because they're trying to wrap their arms around the fact that it's not 3.5 anymore. You know, it's 5.5. And here's another thing before we go to the next buy down, and I'll take questions after that. The thing that's important to note is that you may look at this and go, that's not that dramatic, Ted. Well, it will be if rates keep moving higher. If we go to 6.5, this is going to be a powerful tool, even if it's not, a powerful tool at this point. Any questions before I go to the next one?
Well, just some comments. I think the thing to focus on, Ted, is the salesmanship too. So, guys, we all know that if we're going to take a price reduction on a listing, anything less than $20,000 price reduction is probably not going to get a whole lot of movement. So when we're talking about it with a seller, if we have a buyer on the hook, we could say, look, if we lower the price, right now the market's shifted, you're going to lower the price by $20,000 and probably draw offers even less than that. But we've got a buyer on the hook, and for $15,000 to $26,000. For a $15,000 to $26,000 shift, we're going to get a buyer. We're going to get this property in escrow, and the salesmanship on the buyer side isn't to focus on the rate buy down, but focus on the savings. You're saving $9,000 a year for the life of the loan. That's those two big significant impacts. The salesmanship of it is going to get people off the fence.
And here's the other thing to dovetail onto that is, because you touched on it, but spend a little more time on it. Instead of putting $26,000 towards his buy down, if the seller reduced the house price by $26,000, what's the difference in payment to the buyer then? The buyer's not going to save $789.
No.
They're going to save something more like,
well, $5.25 per $1,000. I'm not a hands-on math guy. I know you probably think I am, Charlene. You think I'm a hands-on math guy. Anyway, here's the point. You're 100% correct. Dropping the price $1,000 doesn't have the same impact as taking $1,000 and buying down the rate for 30 years. That's the important thing to note about this buy down approach. The next one we're going to talk about is going to be a little different, but this one is the most popular, which is why I led with it. And Mike, you make a great point. It is an arrow in your quiver. That's what it is. That's all it is. So all these financing ideas that we all come up with as an industry is to create arrows in your quiver to be able to connect buyers and sellers and have them both walk away thinking this was a great experience. Because that's really, at the end of the day, that's the point. You don't really want a buyer taking a goofy adjustable loan, sleeping with one eye open, wondering if, something horrible is going to happen. Many of us in this room lived through the financial crisis of 2007 and 8. And these products I'm going to be discussing with you today don't set the table for anything like that. This is a 30-year fixed buy down. Let me ask you if you have any questions on this before we move to the next one, let me know. Any questions?
well, at first I thought you were saying that the buyer's paying $15,600 and the seller's paying $15,600, but you're saying only the seller's paying points. This is costing the buyer a dime.
Right. And you'll see here, and let me point it out. Okay, so I'm going to see where it says points. Okay, this one at 5.5% is 0 points. Right. Buyer pays nothing. This one, the buyer pays $15,600, but there's a seller credit for $15,600. So consequently, you see cash to close is exactly the same. Right. So this was my reference relative to the tax implications. The tax implications are the seller absolutely gets a tax write-off because it's in the RPA and it will be in the closing statement that they paid this. Now, the question is, does the buyer also get to write it off? I don't think so, but I've seen it in the past because the buyer actually is paying that money with the seller credit. Does that make sense? Okay. All right. So now let's move to the next one. This one is a little bit more complicated. And I'll tell you that up in the upper left-hand corner, I tapped one of our lending partners to put this together for me to try and make it easier reading. A temporary buy down, the situation with a temporary buy down is that the seller is still potentially paying the money to buy down the rate, but not for 30 years. They're buying it down for a specific period of time. In this first example, what you can see, it's called a 2-1 buy down. So basically what it is, here we go, same sale. I used the same sales price. I used an interest rate of 5.25. Now, the reason I used 5.25 is because I did this one late in the day and rates dropped yesterday. So the first example, I just didn't want to redo it. It was 5.5 because yesterday morning when I did the first one, it was 5.5. At the close of business yesterday, it was 5.25. So I'm not trying to confuse you with that, but let me just tell you on this, at this point in time when I did this, it was 5.25. Now look at year one. Year one is 3.25%. There you see the principal and interest payment. Now, for the sake of this example, I didn't even do taxes and insurance. So this is even simpler than the first one. But my point is you can see right here what the total payment is. The PITI is in there, but I didn't break it down. So I hope that makes sense. So they are $5,971 because the interest rate is 3.25. So they're going to get that for 1 year. And look down here, total buy down fee for this loan is $22,000. So now go all the way to the year 3, which is what the note rate would be if it was just a normal 30-year fixed loan. It's 5.25%. The interest rate would develop a payment of $7,187.92. You see that right there? That's the payment if they just walk in and say, I want to buy this house and I'll take the rate of 5.25, again, with no points. So the buy down says, all right, Mr. Seller, you pay. And by the way, buyer can pay this. No buyer will pay it. But I just should point out that it doesn't have to be the seller that pays this. Somebody's going to pay $22,122. And what that's going to get is 3.25 for the first year. There's the payment. Then it goes to 4.25 for the second year. And then it goes to the actual note rate of 5.25 for the third year. There's no prepayment penalty on this. The important thing to note about this product, both products, is front-loaded interest. That is the easiest way to describe what we're talking about. It's called front-loaded interest. Lender, see right here, getting this money right here, up front.
They're just paying all that $22,000 is all just interest.
Thank you. It's the difference between 5.25, if you wanted to actually break down the math, the 5.25 versus the 3.25 for a year, 4.25 for a year. If you do the math, and it's not exact because there's also the timing of the sale of the loan. I don't want to get into what happens when a loan funds because that's just boring for you and me. But my point is it's front-loaded interest. Okay, so now how am I doing on time? Am I running long?
3 minutes.
3 minutes. I can do this in 3 minutes. Okay, so here is another one. This is for the client who perhaps is just wanting that first 12 months to be kind of like an acclimation point of time. It's only $7,000, takes the interest rate from 5.25 to 4.25.
From where does the buyer qualify? At the highest rate?
On this product, they qualify at the highest rate. On the first buying down the note for 30 years.
Yeah.
So that for qualifying purposes, and by the way, this is one of the reasons I'm showing you both, is because this one, they might not qualify.
Yeah.
Because they got to qualify at the note rate, where the first one, their note rate is being purchased down. So now let's go to, thanks, Ted. See, I did that in under 3 minutes. Anybody have any questions before I exit stage left?
You said rates last night went down a little, so they're right in the 5.25 range.
Yeah, right. They're 5.25, and as you know, I'm not Nostradamus. I don't want to predict rates. But I will predict this. This product is going to be on your radar screen moving forward, even if rates don't go up further. But if they go up further, you're going to see this. And I just want to thank you again for your time. And Charlene, you can forget about that bridge loan. Let's now go for the buy down.
I don't know if my client's called Ted. I don't understand it.
I appreciate the commercial. Thanks again.
Thank you, Ken. Good job, Jen.
All right, appreciate it. Thanks.